Well, there's always going to be a surprise in any given year. And probably the biggest surprise for the fixed income market might have been the reaction around interest rates when the Fed began reducing short-term interest rates, when they began easing fiscal and particularly monetary policy. In the first three quarters, or certainly up until September 18, arguably September 17, interest rates broadly declined across the yield curve. For example, in the 2 and 3 year area of the yield curve, interest rates declined easily over 50 basis points, fully anticipating when the Fed might begin cutting interest rates. Maybe it's a version of buy on the rumor, sell on the news. But beginning September 18th, which is when the Fed first cut interest rates by a large 50 basis point cut, arguably maybe concerned the FOMC concerned about what was happening in the labor market, in the economy broadly, certainly seeing some positive news around inflation. But since that date, interest rates across the curve increased dramatically. For example, the 10-year Treasury increased almost 90 basis points by the end of the year. And why is that a surprise? Well, it's a surprise because it really happens that way. If you were to look back across many different cutting cycles, Jim Bianco at Bianco Research actually pointed this out, that the market reaction on the 10-year Treasury 100 days past that first cut, so past September 18th, that the market recorded the second highest move in interest rates on the 10-year Treasury, for example, since 1981. So that's an interesting parallel, because that was a time too when the country was really dealing with pretty embedded inflationary pressures. But it's a surprise in that there's been 12 different Fed cutting cycles going back to 1963. And it is rare. Invariably, what happens is either rates maybe go up a little bit, but more often than not, they decline. So that would have been, I think, the biggest surprise in the bond market.